Rob's Child, Nothing I Say is Investment Advice. Welcome back to the series on Benjamin Graham's The Intelligent Investor Revised Edition from 1972. Today's episode is going to focus on Chapter 7, Portfolio Policy for the Enterprising Investor, the positive side. Remember, Chapter 6 was eliminating things to invest in, and this is how do you find things to invest in for the enterprising investor, the aggressive investor. Again, the intention of this series is to review the material of the book, learn some clarifications or review some things that you might not understand, and update how these lessons can apply to today and investing in today's economy in June of 2024, specifically as of the recording of this review of this book. And I will also continue to note how it compares to lessons learned from Security Analysis 1940 edition. And so we begin. Chapter 7, Portfolio Policy for the Enterprising Investor, the Positive Side. So what is enterprising? We're aiming for a better result than what we might be able to achieve as a more defensive investor. First, we have a little section mentioning muni bonds and mortgage-backed securities, not getting too much into that. Then we have a section on operations in common stocks for the enterprising investor, and we just review the four main sections of this entire chapter. First being market timing, second, carefully picking growth stocks, third section, bargains of various types, and the fourth category being special situations. So we start with market timing. And this section is relatively short compared to the other sections of this book, but going through the points, he says it takes a special talent or feel in order to really just simply time markets, so they're not going to cover that in this book. He says they think in 1972 a 50-50 portfolio is good, stocks versus bonds, but it's acceptable for the enterprising investor, more aggressive investor, to allow himself to go between 25 and 75% of stocks versus bonds. And it can be allowed if you have conviction about what you think is going on in the economy, in the market, or whatever. And then he says you used to reliably be able to buy low, sell high with formulas, and he says the last 20 years, as of 1972, have acted differently from before, and so it's too short of a time horizon to develop new formulas that'll be reliable moving forward. So all in all, he's saying we don't have the data yet, and it makes me really wonder, well, it's not 1972 anymore. We're a ways past that in 2024, and I wonder what he would think about market timing today. I mean, I know from my own studying of markets and these kinds of things, one of the biggest indicators, the 3-month 10-year Treasury yield curve or inversion. What happens is when the 3-month yield goes above the 10-year yield and then uninverts, every single time that's happened in the past several decades, that's when the recession is starting. That's when it starts. And so I wonder how he would feel about that formula. There's also things like the SOM rule, which have to do with the average of unemployment, basically, and it detects when unemployment is really spiking up, and so that's another one that I think can help with market timing, and I think has proven to be very accurate for today. If you know any other formulas that you think are impenetrable, please comment below. But interesting, this book is so famous, and he says, as far as the time of writing this book, there's just not enough data to reliably do that. I'm not sure he would say that about today. Anyway, moving on to section 2 regarding growth stocks. So basically all growth stocks eventually slow down their growth or stop growing, and the price paid can easily end up being too high. Now, this was a lesson that we thought we learned in the dot-com bubble, but we don't seem to be learning today in 2024 regarding AI. You have people coming out and saying the same things, like the valuation of Nvidia will eventually become 15% of the S&P 500. These outlandish claims of, in order for that to happen, in order for that price to make sense, assume that it grows to that size and stays that size. Well, its earnings have to prove that, and right now its PE ratio is something like 80, I think. So it has to multiply its earnings by about 4 to prove its current price. So it's gotten so far ahead of itself, and so that's just a testament to this first statement here. The price paid can easily end up being too high, and people don't realize that this happens. All growth stocks do eventually at least slow down the rate of growth, and they often eventually stop altogether. So you might say there's exceptions to this rule, like Microsoft seems to never stop growing their earnings, along with a few other choices, but it's again until when, you just don't know. So then we conclude that growth funds have more beta, basically, more volatile. It can go up higher, up, down further, and they're not really better than the common stocks. And when he says common stocks, I think he's talking more about primary issues, at least in this context here. And anyway, I wanted to compare the Russell 2000 to SPX, that's the S&P 500. I wanted to do this just to emphasize his point that, a smaller cap index, isn't necessarily going to outperform the bigger cap index, even though there's more potential growth. And, you often hear the age-old advice. So what do we have here? This black line here is the S&P 500. The red and green bars are the Russell 2000. And a random snapshot starting in 1999, it seems like most of the time the Russell 2000 actually, it outperforms the S&P 500 by a lot. However, you get to today, and if you had just simply held S&P 500 from 1999 until today, your performance would actually be flat. And the further I drag this back in time, I guess this difference starts in 1993, you can see that sometimes the S&P 500, the black line, outperforms the small caps, and sometimes it's the other way around. And that's exactly what Graham's saying here in this chapter, I believe. When it comes to overall performance growth funds, I mean, this isn't even a chosen fund. This is even an index, and he says they're not better than common stocks anyway. So very interesting. So then he says, if fund managers can't outperform using growth stocks, why should you be able to do so yourself? Adds that growth defining growth as more than a PE ratio of the rules from before of current PE ratio of 20 or an average PE ratio of 25 over a 10-year earnings history. Moving on, I'm going to try to go through these points as fast as possible. There's a lot of points that he makes in here. So the next point is the more enthusiasm and price increase a stock has, the more risk it has. And I think this, is especially true for things, growthy things, Nvidia right now. I talk about that a lot in my recent videos made, just because of how ridiculous I think it's getting. And this is just such an important lesson to learn. The higher it goes, the more risk it has. When you have something that has gone up in price, the risk increases because of its potential to go the other way, especially in its relative price to earnings. And, it's not just about price. It's always about price to earnings. I just wanted to throw that in there. So then he mentions potential. There's potential in hodling. He didn't say hodl. That's a new term from today, but he essentially is referring to that method of investing, holding on for dear life. It's a meme that came out of the cryptocurrency craze of recent years. So, but it's best done by people with personal ties to a company because of volatility over time. So basically, if you were an insider in Microsoft from the beginning, it would be easier for you to hold it and watch it go up and down, and understanding that its value is so great that, it's not worth diversifying, because, you have a personal inside knowledge into the company. Of course, that doesn't always work out. If you look at insiders buying and selling, they don't necessarily, I don't think they even do outperform outsiders, people that are not insiders of the same company, typically. A lot of people get excited about their company when it's like there's not, time proves that they were wrong, basically. But the point being, the bigger point here is the ability to hodl is easier with people with personal ties to a company. So, and then we move on to a subtitle, 3 recommended fields for the enterprising investment. So first, before we get to them, he says it has to meet the soundness tests, and it must be different from policy followed by most investors or speculators. I wanted to highlight that phrase only because of the fact that I've said before in some of my videos too, that if everyone had the same investment policy, then no one would get ahead of anyone else. We'd all be in the same boat together. And so that's why you have to be different than other people. I mean, that's just logical sense right there. And so how do you do it? So one way to do it is to find the relatively unpopular large company. So, and there's notes on how to do this, and we'll go through them. So first being, it's out of favor because of unsatisfactory developments of a temporary nature. And he repeats this throughout the chapter. I don't need to go into too many details right now with that, because we will later in the chapter. Then the next one, that they are safer than small caps against bankruptcy and price neglect. And so that can give you an advantage when you find a relatively unpopular large company. I wanted to put 5-star point here. I believe this is why Burry bought Google stock recently, and funny enough, before that was reported, I myself was looking at the PE of Google. It got down to 20, or below 20, I think, for a short while recently. And it did have to do with like temporary issues that people were like, oh, maybe Google's not going to do so well. And then, since then, I believe it performed very well. Anyway, moving on, he mentions that, this way of investing from 1917 to 1933 would not have worked. But since 1933, it did work, and he has a chart to prove it. And, again, I just wanted to note here again, when we're talking about relatively unpopular large company, we're talking about like a ginormous company that has an unusually low PE ratio for this category. I have a 3-star point here, quote, companies that are inherently speculative because of widely varying earnings tend to sell both at relatively high price and relatively low multiplier in their good years, and conversely at low prices and high multipliers in their bad years. So this is a little confusing, right? But relatively high price and low multiplier. So their PE ratio is low while their price is high in good years. So in other words, in a way, it's not high enough. If its PE ratio is so low, then the price of it should actually be higher. But he's saying it has a low multiplier in good years. So in these situations, he explains, companies that have this with, inherently speculative, with earnings that just go all over the place, that go way up one year, one down, way down the next year, those securities tend to have healthy skepticism in good years. So in other words, the PE ratio doesn't normalize, it stays low, and the value of average earnings. So again, like, PE ratio now is great, but and this is something I don't find in regular, like, stock quotations. You don't see average earnings of the past 10 years. I think that would be a great thing for Yahoo Finance to have on the front page of every stock. It would help me a lot, help me personally out, so I don't have to go calculate each one myself. But hey, if the information was too widely available, I guess I wouldn't be able to get an advantage. Not saying that I necessarily will, but I digress. So then we have a Chrysler example of PE ratio low when the price was high, and the PE was high when the price was low. And he says that this is a bad or more rare example, but it shows how buying a high PE and selling a low PE ironically would have even been profitable in an example. He doesn't say that explicitly, but that's kind of what I got out of that point. All right, so section 2 we are in, purchase of bargain issues. Sorry, that's supposed to be 3. This is the third big category of the chapter. So purchase of bargain issues. So first, 7-star point defines bargain as no more than 50% of indicated value, including preferred shares, bonds, and stocks. How do you find these? By the way, I'm going to reference this later in the chapter. I don't know why there's a discrepancy, but we'll get back to that. So how do you find these things? For stocks, you estimate the future earnings or the value, or value it like a private business using future earnings and total asset values or working capital. So, what's the building worth? What's the machines worth? What's your label worth? What are you buying here? And that's how you can determine what, like, the fair value is. And if the stock price is far below that, then you might be doing pretty good. Then he mentions GM as a good example, and I wanted to point out, if you had feelings that way about GM in 2008, at least for the stock, you wouldn't have done so well because of their bankruptcy in 2009. But anyway, moving on, he notes the market exaggerates normal problems in companies. And so every company has litigation, every company gets sued, every company has bad media, a media storm every once in a while, and then in my own experience as well, I've seen it over and over again. The price crashes, then people realize that there wasn't really anything to it. Sometimes it's worse, sometimes it's not as bad, but most of the time it's exaggerated, and the price recovers pretty well with stock valuations for that. So moving on, causes of undervaluation, current disappointing results, and neglect and unpopularity. Of course, being the true opposite of companies that are overvalued, being very popular. And it becomes very obvious when that's all you hear about in the news, NVIDIA stock, NVIDIA stock, NVIDIA stock, NVIDIA stock. Like, anyway, it's almost too easy when you know these lessons from Graham. But anyway, he notes that current bad earnings don't always recover, and so you do have to be careful that if earnings go down, they're not always going to recover. You're not always going to make a good profit just because of the past earnings. He states, look for reasonable stability of earnings over the past 10 years. And then I wanted to add a 7-star point here. He says, no earnings deficit. And so once in a while I come across a company that I see has negative earnings. That's what he's talking about there. No earnings deficit. So he eliminates companies if they've had earnings deficits. I find that to be very interesting because that would eliminate a lot of stocks that I personally thought were undervalued. And they may still be. Again, it depends on the price. How severely discounted is it to current earnings and, average of previous earnings? But, one of Benjamin Graham's biggest things is safety. And if a company can't have positive, at least positive earnings every year for a good record of time, it increases the risk dramatically, I guess. It seems, according to Graham in his book. So, and he says, don't look generally for Chrysler type deals. Stick to the typical rules of current PE ratio or average of 25, PE ratio of past 10 years for large, prominent types of stocks. And then example of an unpopular stock with very sturdy earnings, never getting a PE ratio as high as 15. Basically, this point is just showing how, a stock can be undervalued and stay undervalued for a long time, but there's a range under that if it becomes like ridiculously undervalued, you can wait till it comes back to become somewhat normal. And I mean, that seems to be his favorite way of investing in general, as far as safety and return goes. Then from footnote, when he says net working capital, it is defined by current assets minus total liabilities. If you look at like Yahoo Finance and check the balance sheet, you click the assets and you'll see it right there, current assets, number, amount, and then right below that it has total liabilities. You can see which one's bigger. And in this section, if the current assets, so like their cash, outweighs their total liabilities, then the stockholder is paying nothing for the fixed assets, buildings, machinery, etc. It's basically free. And that's a good point. So that's like a no-brainer kind of situation. When you're buying stock that, it has more money than it even owes, that money is yours. You're a stockholder of the ownership of everything, the debt, the machinery, the buildings, the liabilities. And so if there's more assets than liabilities, then the hard assets are, you can think of them as being free, basically, when you're buying stocks in those situations. Great potentials there. So so this type of undervaluation is great, typically extremely safe against loss and offers great return potential. And he mentions that this can be hard to find sometimes, in certain times where everything's going up and people are really searching for these kinds of bargains, they tend to dry up, disappear. Warren Buffett certainly talks about that, how it's harder and harder to find real bargains out there. And then we have the section, bargain issue pattern in secondary companies. Then we have a pretty long section, and to sum it up, I think of it as a long way of saying that sometimes they fall so low in price they can become a bargain, and sometimes they can basically become too expensive, and mentions the 1940s. I think they were a bargain, then they became too expensive, and then after the 40s they became a bargain again. So again, stuff that's risky becomes safe if it's cheap enough. That's one of the biggest lessons that you really need to get out of Benjamin Graham. So moving on, bargains in secondary companies, smaller, like small caps, smaller companies. He mentions that these will have either and or a high dividend and or reinvest earnings to grow earnings substantially in relation to the price paid. So earnings are going up and up and up, and it's not costing them that much, and they keep growing at a high rate, and that's how you can find those kinds of bargains. And then third, this is adding to this list, the bull market will usually raise undervalued securities to a reasonable level. Also, during normal times where things aren't too crazy any which way, they can go from being undervalued to go up to become a normal level. And then fifthly, new conditions, policy and management can benefit a small cap company. So unexpected changes in a positive way can benefit companies at a bargain price. And then he mentions the acquisition of smaller companies, basically arbitrage potential. We're talking about companies that are just like ready to be bought by a bigger company, like a smaller computer company specializing in some little thing that gets bought up by Microsoft. A good recent example that comes to mind is Activision, which was actually recently bought by Microsoft, and that exact arbitrage was taken huge advantage of by Warren Buffett himself. So, and Warren Buffett attributes a lot of his success to Benjamin Graham, this book, his thoughts. This is where it comes from. This is the source. Anyway, to continue, the commentator mentions buying distressed bonds after the dot-com bubble wasn't really possible for small investors because you couldn't get enough diversity in the bonds. And I wanted to mention, well, yeah, but funds like HYT didn't exist, high yield corporate, where you can get a lot more diversification and they manage it for you. And I think that tool, again, would be an amazing vehicle in Graham's opinion. Moving on, part 4, special situations or workouts. He says they've become harder to find, arbitrage through assumed acquisition target, like the example I just said. And then we're talking about railroad bankruptcy bonds, happen to be very profitable. They were doing really poorly, the companies, and so, but through the bankruptcy proceedings, the bondholders are still like, hey, you owe us, and no one wanted to buy them, but people that did buy them benefited massively from those things. Then we have public utility companies were one of these special situations where they were functioning as holding companies, but they were legislated through government to break up into smaller companies, and then the values of these smaller companies really shined. They went from becoming really undervalued to becoming more fairly valued. So that was another special situation or workout. And then Triple Star mentions common undervaluation comes from litigation. He mentions a popular Wall Street phrase. He says, never buy into a lawsuit. And he says that, yeah, okay, that's, we get it, for guys that don't want to deal with the fact that it's going to become very unpopular by the public, and so it's going to go down in price. But for Graham, this offers, a great opportunity. And I personally have seen this in my lifetime many times, where you see a lawsuit with a pharmaceutical company, insurance company, you name it. The lawyers come in and it's all over the news, and everybody that has the stock gets scared and they sell it. The price goes too low, and then it resolves and people realize, oh, it's still a company and it still makes money, and it probably didn't deserve to drop that much. And that happens a lot. So whenever you see a company on the news that is getting bad, reports on them, it's something to look into. It's a potential good opportunity is the whole point here. And then he says that, all right, so this book, The Intelligent Investor, is not the one for details for discovering these kinds of opportunities. In other words, it is complicated. And that's where we bring up security analysis. We do go into a little bit more detail, but it's like the amount of detail does involve the industry itself, and so but yeah, there's more of that in security analysis. Moving on, we have another subtitle into the next section, broader. So this is kind of summing up the chapter, broader implications of our rules for investment. So he states, number one, there's not really any room for semi-aggressive investors. You're either all in or you're all out. You can't be, there's no middle ground or you'll be disappointed. And the way he sort of illustrates that is, a half businessman doesn't make half the profits of a businessman. And I like that phrase a lot. I like that a lot. But anyway, moving on. Defensive investors should not try to be aggressive. You're either aggressive and you do your homework, you do all the work needed to make your decisions, or stick to defensive investing. Otherwise, you're just gonna end up getting hurt, basically. And he stresses with italics for the aggressive investor to use established business standards. Don't just make it up as you go along. Which is interesting. And I think we'll go into more of these details throughout the book. And then he has a section where he sums up basically conclusions over the last 2 chapters. So don't buy the following at full price. Don't buy foreign bonds. Don't buy ordinary preferred shares. What he means by this is preferred shares that don't have special features, like cumulative preferred shares are worth much more than regular preferred shares, for example, or convertibles, something you can turn in for the common stock, obviously. And then also secondary common stock, so like small company IPOs. Don't buy those at full price. Wait for the public to go in there and scramble and fight over it and have the price double and triple and have it all hit the news, and then everybody wakes up and is like, oh wait, this company doesn't make any money yet. Reddit. And then it's just, how many times does this have to happen? I mean, anyway, some of these are just obvious. But moving on, defensive investors, stay away from being aggressive. Don't be aggressive. Enterprising investors buy these kinds of things at a bargain, and he describes here not more than 2/3 of the appraisal value of the securities. And I swear earlier in the chapter he said 50%. If anybody has any other insight on the discrepancy between 66.6% and the 50%, comment below. And then he says, ironically, he gets a little humility here and says that if everyone follows our rules, then nobody wins. So and the really ironic part about that is formula investing. So if you have enough people doing the same formula, eventually it just doesn't work out. It's just a mathematical truth. But then he says secondary issues have greater potential for growth, so why not buy them at a normal price? He says some people are asking this. Well, and because of it, it's true. Secondary issues, small caps, a little company, at the beginning, like, why not buy those at full price when they have the potential to grow to be so huge? And what he says here is he basically is trying to excuse himself and say, well, it's my experience, and I know that they get cheap, very cheap sometimes. So just be patient on these things. They will get cheap sometimes. Wait for your opportunities. Don't jump in. Don't jump in with the rest of the crowd and pay full price. And then he talks about how there's more important and controversial difficulties between insiders and outsiders of small caps. The point being that a bigger company doesn't have as much risk in as far as the relationship goes between insiders and outsiders, and I've found that to be very true. Can't tell you how many microcap stocks I've looked through when I first started looking at investing, and realizing how bad it can get, how bad a lot of the common stockholders outside, the outsiders, get furiously mad at what the insiders are doing. There's so many examples of junk stocks, I guess, micro caps, I guess we can call them, small caps, where the valuation just goes down forever, and they just keep issuing more and more and more shares. They just keep getting more money from people that don't know what they're doing, and it's terrible. And that's not going to happen so much with large cap companies. None of that kind of shenanigans. And then we end with there is indeed a middle ground between primary and secondary issues, whether you regard something to be a big, prominent, solid company and something that's not, something that doesn't fit that category. He says there is a gray area. And then I don't understand why he does this, but he has a weird excuse about saying, there is a line in the sand between defensive and aggressive investors, but there is a gray area between primary and secondary issues, as if these two separate topics somehow relate to each other. I don't get it. I think he must have been tired when he wrote this part. But anyway, that's all for this chapter of the Intelligent Investor by Benjamin Graham. Chapter 7, Portfolio Policy for the Enterprising Investor, the Positive Side. Hope you enjoyed. Thank you for watching, and I'll see you next time after you read Chapter 8, and we'll review it together in the next video. Rob's Child.